what I'm seeing in Hyperliquid in terms of the growth of applications on that chain after just 1 year of being around is pretty extraordinary. It's gone from like 1 application to 40 applications, which is more than Sui. And it puts it in sort of like top 5 or 6. Now Sui's just there as well, but then you obviously got BNB, the established players like BNB, Solana, Ethereum, of course, and Arbitrum and Base. But you know what you're seeing in these emergent L1s being Sui and Hyperliquid is the net worth growth aspects, which give you confidence that even though you're out the risk curve in them, that you're seeing the kind of growth that we did see in Solana in the previous market, in the previous bull market, that, you know, provides confidence that, okay, even though value is concentrating, they are now growing more aggressively or faster than the more established L1s, and they will be around, most importantly, in 5-10 years from now.
Every crypto bull market follows a familiar rhythm. Bitcoin moves first, then altcoins explode. We saw this clearly in 2017, when Bitcoin surged to nearly $20,000, only to be followed by Ethereum's 9,000% rally and dozens of smaller tokens hitting unimaginable valuations. The same pattern repeated in 2021, when Bitcoin's climb to $69,000 sparked altcoin mania. Solana went from under $2 to above $250, Avalanche rose from under $3 to $146, and countless DeFi and NFT projects came to life. Now in 2025, the cycle looks ready to play out once again. Bitcoin has been steadily climbing since last year's lows, and now altcoins are beginning to show explosive strength. According to CoinMarketCap, the altcoin season index recently touched 79, its highest level since December 2025, when it peaked at 87. This latest spike confirms a fresh wave of capital rotation into altcoins. The total altcoin market cap has already rebounded to $1.74 trillion, and several tokens are flirting with new all-time highs. This is where the analysis from Real Vision CEO Raoul and chief crypto analyst Jamie Coutts becomes so valuable. Together, they break down which altcoins are rising to the top and the signals that separate short-lived hype from lasting dominance. Their framework doesn't just look at price. It digs into applications, settlement volumes, and economic activity on-chain to identify the real winners of this bull cycle. Before we dive in, make sure to hit the like button, subscribe for more deep dive analysis, and stay with us until the end, because this conversation could help you spot the next leaders of the crypto bull market. Thanks for the support and enjoy the video.
So let's first talk about layer ones. And you and I have kicked this around for a long time. I don't believe that revenue accrued to the chain itself is the key metric, and it confuses people. How are you thinking about this now?
It is an important metric because it shores up the security of the chain, but at the same time, the trend is lower transaction costs. So if you look at revenue as a share of settlement value, that is going to continue to decline. I think it's an important thing to understand, but there's probably better ways to synthesize fees in more of a relative valuation metric, like fees relative to some other aspect that defines value on the chain. That's probably more relevant than just looking at it as in a gross or a sort of a nominal basis. I've started to really dig into a little bit more around some of the valuation frameworks. And, you were like one of the guys who came out early with sort of the Metcalfe's Law framework, which was modeled on settlement values and daily active addresses. And no doubt that there's that just models price. A lot of the things though in crypto model price because, the metrics that we use are the dollar-based metric or defined in the price of the actual token. So if the token increases, so does that metric. And it's very hard to disentangle how much of it leads one another or what leads. It's the ongoing issue with crypto in that, how do you value these? Where is the predictive value in all these on-chain metrics? And I think this jury's still out. But if you look at things like settlement values, right? The set, which is part of your Metcalfe's Law framework. That's that doesn't get talked about enough, which is like how much value is actually moving across these networks, how much of it is stablecoin orientated, how much of it is just peer-to-peer transfers.
Because if not, you're kind of measuring the activity of the economy based on the fees that the banks make or something, or the telco providers. Right. And that doesn't make sense, right? Because on top of the telco infrastructure or the internet infrastructure is all of the value that comes on top. And if you don't capture that, then you're not capturing the actual value of the network itself and what you can use it for.
Absolutely. It's a multifaceted approach. So if you just look at fees, or if you just look at users, you're missing a lot. If you just look at one of these metrics, they're not telling the whole story. And they're also pretty much at every metric can be gamed. Yeah. That's also the problem. So you need to have a multi-factor approach when looking at this. So I look at
the hardest one to game for an extended period is settlement, because that costs you a fortune. You can game wallet addresses, you can game active wallets, you can game all of that, but it's really hard to game total value transacted or total value settled.
Yeah, because you're paying a fee on that. Like someone's paying the fee. Now there is still scope for some around that as well within chains.
Because there is in all of crypto, there's general is what you need to assume at all times.
You do, yeah. So you have to look at all these metrics with some degree of skepticism, but if you can build up a patchwork of them to tell, is this network expanding? So you mentioned like layers, which is a critical element. So you've got the fees, which is maybe in isolation, just an expression of like rent seeking, right? But if the number of applications on top of that network are expanding, and the number of interactions between those applications expressed through diversity of transactions, so borrow, lend, dexes, perps, social applications, and then the settlement value, you get a much more complete picture of, okay, fees are growing, but as a percentage of the overall value, that might be declining, which means that this chain is essentially becoming more efficient. And the tax or the toll to operate in that network or in that economy is declining as a percentage of the overall GDP. And so
that's another way of thinking at it, because you and I have talked about these as economies and we're looking at GDP, and tax take is not necessarily the best measure of economic activity.
No,
it's kind of another way. And you might say the fees are the taxes, as you said, to operate within the economy, but that's not necessarily the full value that the economy transacts.
Yeah, like if you compare it to a country, right? So if it's just, if there are no other alternative countries to go to, then that country has got monopolistic sort of pricing power and will overcharge for services to a point where people start to get fed up and move elsewhere. And that kind of happened in 2020 and 2021. So yeah, and Ethereum knows this, and Ethereum's going through its scaling mission, and that's why you can see that it's performed very well this year in terms of most metrics. Fees have been strong, but fees have actually been declining because they're making those strides to make costs in the Ethereum ecosystem cheaper.
So that's kind of like a government deregulating the economy, freeing it up, charging lower taxes, creating a better free market economy. Because before Ethereum, to your point, back in 2021, with the economic activity that was going there, was too expensive. It was the California of the crypto economy, and everyone's like, "Yeah, we love it here. It's amazing, but I can't afford to live here any longer."
Yeah, we don't like the policy, so we're going to move.
And welcome to Solana.
Yeah,
or the layer twos.
Yeah. Exactly.
So you think of the layer twos as kind of different states somehow within that equation, and they're cheaper, offer lower tax breaks, but they're not quite as good. There's not as much policing around, so they're not as secure. It's amazing how similar this is once you think of it in economic terms as digital economies.
Coutts makes a crucial point. Revenue alone doesn't define the success of a blockchain. Just as you wouldn't measure the strength of an economy solely by the taxes its government collects, you can't measure a chain only by the fees it charges. What matters more is the settlement value, the sheer amount of money actually moving across the network, combined with the diversity of applications and use cases. That's why Pal and Coutts stress a multi-factor approach: fees, active users, application growth, and settlement values. These together tell the true story of whether a blockchain is building a sustainable digital economy. Ethereum's recent scaling push, for example, lowered fees while still increasing overall activity, much like a government deregulating an economy to unlock more growth. This broader lens allows investors to see which chains are truly becoming indispensable platforms. And that brings us to the next big question. With capital rotation underway, which layer ones are standing out right now, and which ones may be losing ground?
So, layer ones in your models, what's looking interesting, what's not interesting right now? We're starting to see picking up of activity overall, but it's still not quite perfect. But so what are you seeing in your models?
I just see that we've got a situation where value is concentrating in the top L1s, and I think that it's becoming harder and harder to maintain a thesis around these tier twos in the smart contract platform world, or tier threes, let alone, as value does get more concentrated in the larger.
And what are the tier 1, 2s, and 3s? Give us examples of them.
So if you just look at settlement value, this is actually in the next report, Raoul, which will be coming out in the next couple of days, but I focused in on settlement values, right? So, one half of your Metcalfe's law model. Yep. This is a breakdown of settlement volumes across L1s and L2s, most of the large ones. So Ethereum this is a 30-day median. So it's about 28 billion per day, which is just, wild when you think about it. Tron, which, has much lower application diversity. It's basically a one-use chain, and does have governance issues as well. It's not, you couldn't never claim it as decentralized as Ethereum, but it settles about 24 billion. Wow. So right there you have, the lion's share of all settlement value across the crypto ecosystems. Now, Solana and Sui, which has really raced up. The growth rates in Sui this year have been phenomenal. And I'm trying to dig a little bit deeper in terms of like where that value is sort of flowing from and to.
I think it's because I did the work on it in GMI and looked at its relative growth versus Solana, because similar fast performant modern chains. And I mean, it's massively outstripping the speed. Obviously it's at earlier stage. So of course the rate of change. It seems that it's the Bitcoin settlement layer that's big, plus stablecoins are moving fast. And the DeFi ecosystem is starting to work as well.
Yeah. So Bitcoin on Sui. Well, I mean, I was genuinely surprised that Sui had increased its position in terms of settlement values to where it is now, where it's rivaling Solana. So that's pretty phenomenal. BNB still there. It does.
Yeah, and just again, for people to frame this is the settlement value of Metcalfe's law. When you look at Solana, there's more active users. So, of course, Solana is still worth more than Sui, which doesn't have as many active users, even though it's settling the same amount. It's like Doge has a lot of value as a market cap because it has a lot of active users and holders and less so of the on-chain activity. So it's like you can have different variations of this that drives the overall market cap value.
Yeah. And there's no perfect mix as well. I would argue that application diversity, is a very important metric overall. That takes time.
As if not, it's like, again, going back to the economic example, it's like the Saudi Arabian economy is just oil. Can be very profitable, very rich, but it's so driven by one factor. So the more diversified the economy, like the US economy, for example, the better it is.
And Saudi Arabia knows this, and for the last 10, 15 years has been diversifying its economy aggressively because it doesn't want to be solely reliant on that, on a commodity. Yeah. So, I mean, when you look at the settlement values, there are, there's a whole lot of, there's
so
some
sorry, I can't see the chart, but where's Hyperliquid? Because it has shot into almost the top 10. It's now currently larger than SUI, but it doesn't appear so high in settlement volumes. Is that right?
Yeah, so I should caveat this too. So the settlement volume data is coming from one of the on-chain metric companies, so Artemis. And what goes into settlement volumes are a couple of different things. You've got the stablecoin transfers, you've got peer-to-peer transfers, you've got, the equivalent of like whatever network, the ERC20 token transfers, NFTs, Hyperliquid. When I check the data, they're only capturing the DEX volumes, which is spot volumes. Which is
so not the derivative volumes on top.
They haven't captured they're excluding derivatives volumes, but they also have not addressed the peer-to-peer transfer side. But Hyperliquid's a very young chain, so that is quite small, but it's also being undercounted. So some of these numbers are probably not 100% reflective of the true state, but I think that they're pretty good proxy for, where things are now. There is a table in my upcoming report which looks at settlement values as well as applications. So, how many protocols are now on the chain? Because obviously Hyperliquid didn't start as a chain. It started just as a perpetuals trading venue. And then it launched a chain, and then it went after applications. What I'm seeing in Hyperliquid in terms of the growth of applications on that chain after just 1 year of being around is pretty extraordinary. It's gone from like 1 application to 40 applications, which is more than SUI. And it puts it in sort of like top 5 or 6. Now SUI's just there as well, but then you obviously got BNB, the established players like BNB, Solana, Ethereum, of course, and Arbitrum and Base. But what you're seeing in these emergent L1s being SUI and Hyperliquid is the net worth growth aspects, which give you confidence that even though you're out the risk curve in them, that you're seeing the kind of growth that we did see in Solana in the previous market, in the previous bull market, that, provides confidence that, okay, even though value is concentrating, they are now growing more aggressively or faster than the more established L1s, and they will be around, most importantly, in 5-10 years from now.
Looking across the crypto landscape, Jamie Coutts' models show that value is concentrating in the top layer 1 chains, making it harder for lower-tier projects to keep up. Ethereum, with around $28 billion settled daily, still leads by a wide margin. But the real surprise is the rise of Tron, settling over $24 billion a day despite having limited application diversity. Meanwhile, Solana and SUI are both racing higher, with SUI's settlement growth this year rivaling Solana's pace during its explosive run. Coutts even notes that Bitcoin is increasingly being settled on SUI, alongside the rapid growth of stablecoin transfers and DeFi. Then there's Hyperliquid, a chain that began as a derivatives venue but has quickly transformed into a full ecosystem. In just 1 year, it expanded from a single application to more than 40, putting it in the top 5 or 6 blockchains globally. Despite being young and still undercounted in on-chain data, its trajectory is clear. Hyperliquid is growing faster than many of its more established rivals, echoing the same growth curve we saw with Solana in the last cycle. Coutts argues that these signs give confidence that both SUI and Hyperliquid will be around in 5 to 10 years, not just as speculative plays, but as pillars of the digital economy. The takeaway is simple. As this bull market accelerates, not all altcoins will survive, but those with expanding settlement value, strong application ecosystems, and sustained user adoption are positioning themselves as the cream of the crop. For investors, that means looking beyond short-term price action and focusing on the metrics that reveal long-term resilience. If history is any guide, the biggest winners of the coming altcoin season are only just beginning their ascent. Drop a comment below with your thoughts. Which layer 1 do you think will lead this cycle? Ethereum, Solana, SUI, or Hyperliquid? If you found this breakdown valuable, make sure to hit the like button and subscribe to the channel for more expert-driven crypto insights. Thanks for watching, and I'll see you in the next one.